Hi everyone, I welcome you back to the discussion on this particular section where we talked about the testing of the business model for financial assets classification. Friends, what we have talked so far that ideally we look at this particular condition where we say that a financial asset shall be measured at amortized cost if the financial asset is held within a business model whose objective is to hold financial assets in order to collect contractual cash flows, and of course, there is another condition that we would want to discuss at a later point in time. We said that it is not necessary for the company to hold all these investments until maturity, right? What does it mean? It means that yes, the company has a flexibility to be able to sell these investments well before maturity also, right? So that is something that we wanted to say, that some investments may be sold before maturity. It is important to consider now as to what is meant by the word some investment here, right? We are saying that if there are sales of some investments with an insignificant proportion to the total portfolio. If there are sales of some investments out of the portfolio, however, these investments are not significant, right? While might be frequent, right? So again, the focus goes back to the value of the investments rather than the the frequency of the selling of these investments here, right? So if that is happening, this does not impact the business model test, right? That means that you can still use a cost model if you are, if you're willing to, if you want to use that cost model. Okay, so obviously to avoid all the volatility part of it. But then the standard further expects us to look at under what circumstances are sales being made. Right? Why are you making these sales, even if these are, let's say, insignificant in value, right? So my standard has to, not just look upon the intent of holding, these investments, but also looking at what is the exposure that gets affected, what is the value of that investment that gets affected because of these sales come into the picture. So all these aspects would come into a collective consideration to assess whether the contractual cash flows are collected the way they were supposed to be, right? So whether this business model test is, accomplished rightly or not. Okay. So when I say this, the circumstances would expect, or the circumstances would need to be looked upon, not just considering the current or past information, but that would also consider or take into consideration the future information. Okay, let's try to understand what are we discussing here. Let's try to understand what does it mean. Okay, so we are saying that if there is a portfolio of customers a portfolio of assets, so it could be, for example, let's say credit card balances due from the customers. It could be a significant exposure. Okay, so we are saying that the company keeps on assessing the worthiness of the customers, their paying history, their possibility of delays and things like that. And the company identifies that many card holders may not pay. They may not pay in time, or they may not pay at all. Okay, and that is where you start assessing the factors that why does the company think so, right? What all considerations have come to the minds of the company as to decide that yes, or as to probably kind of conclude that the customers may not pay. So it is not just about the current situation, but also the forward looking information. So there could be a possibility where that there are, for example, some fee or some interest payments due on such credit cards, or if there's another set of portfolio, that okay, so let's take another example on that a banking company has given a housing loan. Okay, and now you consider as that banking company that the value of the collateral, the value of the property is going to go significantly down, and as a result of that, the borrowers who have taken the loan against that property, they may not come back to the banking company at all to repay the money, right? Think about it like this. So when this is a possibility, so you start looking at more of a forward looking information there. So the company would not wait for that event to happen that people have started defaulting. Okay, and that is where they may decide to probably sell a portion of the portfolio, because now they think there is a credit risk with respect to the recovery of those financial assets, right? So when you talk about these kind of instances and you want to sell some portion of the portfolio of your assets, even in that case, the cost model would be applicable to the business. Are you fine with that? Right? So that is something which is an important consideration to make till the time the company is able to justify that the reason of making this sale is more confined to the continuation of the business rather than getting into the trading mode or a speculative mode or more of a selling behavior, right? So this is something which is not going to impact the cost model classification or the cost classification there. All right, let's have a look at some examples here, the broader examples where we see that the business model test would continue to exist as far as the company's business is concerned. Okay, so let us say that there is a bank XY holds financial assets, okay, until maturity. So the contractual cash flows will come handy there. But if I say that the bank also performs credit risk assessment for such financial assets and may sell or has sold. So it is talking about something that might happen in future or it has already happened in the past. Okay, so the financial asset, it may sell or, for example, has sold these financial assets if the financial asset does not meet the credit risk criteria, right? So if I say that I've given a loan to a customer and somewhere the rating of that customer has started deteriorating, or there's an information and or a likelihood that the credit risk is going to be higher, with that particular customer or a portfolio of such customers. So selling these financial assets does not impact the classification of the cost method as far as the entire portfolio of these financial assets is concerned, right? So what we are trying to say is, yes, the fair value criterion brings the volatility. That's why probably businesses expect to have the cost model with them, okay? But then the decision or a risk of non-recovery, a risk of default should not stop, or let's say a risk of going into volatility of the financial statements should not stop the companies to avoid the credit risk. Okay, so that is where the standard gives a lot more flexibility to let the businesses decide that if they want to sell something which is probably going to be probably going to be a default, they may very well sell it beforehand, and then that should not penalize the companies to go to the fair value model, because that brings, of course, the volatility. Are you fine with that? So what we are saying here is, precisely in such kind of instances, there the entity's objective to hold the financial assets to collect the contractual cash flows is not affected. Are you fine with this? Right? So in this case, of course, we are saying that any such kind of instances would not deter the company to use the cost method. Okay? Let's take another example on this. It's going to be the easier job here. Okay? The bank XY holds financial assets, let's say home loans, with an average tenure of, let us say, 20 years. Okay? So in this case, we are saying that if some customers do not pay in time, so all the installments which are falling due, if some of them are not being recovered, the bank may approach these customers, of course, seeking recovery. All right. So the bank may approach these customers to seek recovery. All right. Now, here we are saying that the collateral might be sold, or there could be other ways in which, of course, this financial asset, the recovery of the financial asset would be managed. In this situation also, of course, the very objective to collect the contractual cash flows is not getting affected, which means that even in these cases, of course, the bank would continue to use the cost model to, let's say, account for these financial assets again. Are you fine with that? Right? I'll take another example on the same scenario. If I say that let's assume that all these home loans were given at a fixed rate. Okay? Right? But the bank now perceives probably the interest rates may increase in future. Okay? So, if the bank now gets into an interest rate swap where it would move from fixed to variable, right? So it's basically a fixed to floating. That kind of a swap the bank enters into, it still does not impact this categorization, right? We are still saying that the business's objective is to, for example, recover the contractual cash flows. Such kind of swaps or such kind of derivatives would not change the business model of the entity. You're still recovering the interest. The interest may not come in form of a fixed rate, but it might come in form of a variable rate. So that is something which is again a part of the discussion of this particular section here, right? So around these lines, you would start noticing that the standard brings in a lot of genuine flexibility to the companies to still use the cost model, while the fact remains that there are some sales still being made by the entity out of those financial assets which were expected to be otherwise held until maturity, right? So that is something which is one section that I wanted to kind of cover with the help of some examples, where we identify how this so-called as the business model test be done as far as the first condition is concerned. The financial asset is held within a business model where or whose objective is to hold financial assets to collect contractual or in order to collect contractual cash flows, right? So that is something that I wanted to talk about in this particular discussion with you. So keep watching these videos, look for more on financial assets and financial liabilities, financial instruments per se, and do subscribe to our channel. Thank you very much. Have a good day. Take care.